I'm Nadia Gurwell.
I'm John Gugliatino.
I'm Michelle Blanchard. Welcome to 30 Minutes. Welcome to 30 Minutes. I am your host, Michelle Blanchard. My two guests today are Robert Morey, broker and regional director of Northern Fairfield County RE/MAX, and Patrick McRedmond, vice president of residential lending at Fairfield County Bank. Our topic of discussion today is the mortgage rate environment and the real estate environment. Gentlemen, welcome to the show.
Thank you, Michelle.
Yeah, thank you so much.
Happy to be here.
Thank you for coming here. And Robert, why don't you talk a little bit about who you are, what you do?
Certainly. I'm a real estate broker. Had my license in Connecticut since 1980, so I've been doing it a long time. Local person, born in Danbury Hospital, grew up in the area, so I think it's important to know your community if you're going to sell your community.
Mm-hmm.
And what my primary role is to help buyers and sellers of residential real estate do some commercial real estate, but most of my business is residential, whether it's finding people a home, listing a home for sale, marketing it for them, and managing the process. As I've seen studies that's among the most stressful times in a person's life when they're buying a home.
Right, managing expectations.
And managing expectations as well. And we do that, certainly help with business partners like Pat, helping get through the process. That's an integral part. We work in concert with other professionals that are part of the process.
Mm-hmm, absolutely. Thank you. Mm-hmm. And Pat?
Much like Robert, a lifelong Greater Danbury area resident. Currently live in Brookfield with my wife, 3 children. Started in the mortgage business back in 1992 with a company called McHugh Mortgage Company. And in 1995, I moved to Ridgefield Bank, which then became Fairfield County Bank. Mm-hmm. So I've been at basically Fairfield County Bank for 22 years, senior loan officer. I help people understand the mortgage process, pre-qualify them to help them decide or learn what they could qualify for when they go to buy a home, educate them on the important pieces of the process, from credit to income. We look at anything from single-family homes to 2, 3, and 4-family properties, as well as condominiums. Mm-hmm. We also will help folks refinance their homes, offer home equity lines of credit, and generally just assist them through the lending process to take them from application to closing.
Now, do you provide like VA loans, reverse mortgages, those types of products, or are you strictly more conventional FHA, FHA?
We do quite a bit. We haven't offered the reverse mortgage in a couple of years. Mm-hmm. We can make referrals on that product, and it's an excellent program. It really is. Primarily, we offer conventional lending, FHA. The state of Connecticut has a first-time buyer program called CHAFA, Connecticut Housing Finance Authority. They also have a down payment assistance product that we offer, and we work through a housing development fund in Danbury, otherwise known as HDF, to offer 100% financing for first-time buyers. Mm-hmm. The VA loan we don't currently offer. We're always happy to assist a veteran with financing options. But a VA loan does have some special components that makes it attractive, and if a VA loan is the best loan for a client, we can make a referral to somebody who can offer.
Right, right. And where do you see the mortgage rate environment right now? Are you seeing more refinances? Are you seeing more first-time home buyers?
That's actually a great question. With rates having risen in the last couple of weeks in particular,
right.
We started to think that the refinance market might start to dissipate. But the reality is there's always a refinance market out there, even in higher rate environments. Currently, though, I would say the loans I've been working on for the last month and a half have been pretty evenly split. We've got a pretty good refinance market, partly due to the fact that there's a lot of people that have stayed with adjustable rate mortgages over the last several years. Their loans had low rates and were adjusting to low rates on an annual basis. The last year is the first time they're actually seeing those rates going up.
Right.
So those borrowers are coming in to lock in a longer-term rate option. There's some borrowers we have that have large home equity line balances, and with some of the changes to the tax laws going forward, and also the fact that most equity lines also are variable rate in nature, and those rates are going up, they're seeing an opportunity to possibly combine the two loans into one lower rate, fixed rate first mortgage product. But you know, the joke is the spring market starts sometimes in January, depending on the weather.
Right.
I think I learned that from Robert. And
And
you know,
probably not the spring market in January, right?
although you know, oddly enough,
Relatively busy, yeah.
it's
Oh,
been
good,
very busy.
good,
It's been
good.
very busy. A lot of people coming in to get pre-qualified, get pre-approved.
Oh, good.
And yeah, I'm very optimistic about this year's purchase market.
Oh, good. And one question that a client actually asked me, getting back to your comment about home equities and the recent tax law changes, if someone has, and you may or may not know the answer to this because I'm having a hard time nailing down the answer myself, and I know that the IRS is still issuing some guidance, but if your only mortgage is a home equity, do you still qualify for that deduction, or because because it is a home equity, do you lose that mortgage interest deduction? How is that determined?
You know, that's an excellent question, and one
Yeah.
that we're still seeking an answer to
Okay.
ourselves.
Okay.
I've got some friends that are CPAs, and they're going through the changes as we
Yes,
speak.
yes.
And I haven't had that clarified to my satisfaction
Okay,
yet.
all right, thank you.
Sure.
And-
It is a good question, though. That's,
Yes,
it
there
makes us
are a
up to think,
ton of
yeah.
questions out
Sure.
there that are still up in the air, as I'm sure the both of you know.
Sure.
So let's talk a little bit about your feelings on the real estate market.
Well, the real estate market, Michelle, has been, it's actually been pretty brisk the last few years. The sale prices have been flat, though. I think, you know, we've got some issues at the state level. I don't know if we're particularly well managed as a state. And so I don't have the final numbers for 2017 yet, but I know in 2015 and 2016, Connecticut was the only state in the country where the average sale price did not go up. So if you hear, you know, those commercials on the radio about, you know, prices have increased 6%, these are their national numbers. We still have some of those distressed properties, foreclosures and short sales out there, whereas many states have worked through that inventory and recovered. The laws are such in Connecticut where the process takes a little bit longer. So while nationally we've declined from, say in 2012, about 35% of all the properties on the market were those distressed properties, to now it's, you know, maybe 5, 6, 7%, but you know, it's far lower. It's still an issue in Connecticut, and there are more foreclosures that are coming. There's still properties that
Right.
have been on the market for, you know, there are short sales that haven't been foreclosed yet.
Right, and that was going to be a question because I've heard some things, and again, I don't know if it's true or false, that the short sales and the foreclosures have kind of been handed out, if you will, so that they're not flooding the market, they're not depressing the market. So they're
There are, I mean, there has been a, like maybe they're managing the spigot, I guess, to
Yes,
some degree.
yes.
I mean, they're still out there. You know, and sometimes you might find somebody, a first-time home buyer who's attracted to the listing by the price, not realizing the scope of the work that might be involved. Because a lot of times it takes a while to clear up the title of these properties, so they could be vacant over a year, and a lot can happen in a year. A pipe could burst,
Yes.
all sorts of damage.
Yes.
Whereas many of them are also being bought by people who renovate them and resell them. They're typically known as flippers. They buy them they buy the property and invest some money and resell it at a higher number. And I work with some of those folks as well. And those are the people who typically are in a position to buy the foreclosures. They'll usually be a cash buyer. They'll buy them. They'll
Right.
be already understand the cost to renovate and have a sense as to the market. So that's a larger segment of that. Short sales are different only because they take a lot more time.
Right.
Because a short sale essentially means that you owe more on the property than it's worth, but you also need to demonstrate a hardship. A lot of people, because in the Great Recession, we all lost about 30% of the value of our homes. So there's a lot of people who might have been technically underwater, but they were still making the mortgage payment. The short sale has to have a hardship. And because the bank might be looking at a $50,000 or $100,000 loss or more, they put the seller through what I commonly refer to as a mortgage application on steroids. They make.
I was going to ask Pat, what's the process
Yeah.
for that?
Yeah, basically, they have to go through a process where they are examining every conceivable asset that person has to make sure there is no way for them to to repay that debt. And then at that point, the bank will make a decision, because they may still give them the right to sell it for less than it's worth, but depending on the strength of that seller, they'll either have to sign a note for the difference, or they'll have that difference forgiven. The problem is that there was a law, federal law in place that's since expired, which allowed, didn't categorize that forgiveness of debt as taxable income. And so I can see that could be a hardship too. If someone's in the position where they're upside down on their house, they can't make the mortgage payment anymore, and then all of a sudden, Uncle Sam sends them a bill for $40,000, it just exacerbates that problem.
Absolutely, yes. And Pat, are you seeing a lot of applicants for short sales? And tell us a little bit about that process.
Not really, with my bank.
Okay.
Fairfield County Bank is a mortgage banker, so we originate loans. Some we keep in our portfolio, many we sell. We fund a lot through Fannie Mae and Freddie Mac correspondent lenders and other larger banks that we partner with for financing. So a significant amount of the loans that we originate on an annual basis, we do not keep. We're offering the service of taking the application, approving it on a local level, using local vendors, like appraisers and so forth. We know the local attorneys, the real estate agents involved, insurance agents in many cases. So, we're offering a service that you may not be able to get from a larger bank, but ultimately we're too small to really service a lot of these loans for Fannie Mae and Freddie Mac.
Right, absolutely. Now, I met the two of you recently, probably last year, as part of the National Association of Divorce Professionals. And it's a networking group, as you know, that really unites professionals who are helping clients go through the divorce process. And I love it in the sense that I can reach out to you, or I can reach out to you, Pat, to ask you all of these questions for my clients who are going through the divorce process, because a lot of the information is changing, and I don't have enough time to keep abreast of all of the changes. So how long have you two known each other, and how long have you two worked together?
Probably 1993.
Yeah, 93.
Yeah, there was a condo project being built in Danbury at the time, known as Liberty Terrace. It's the one that's next to the hockey rink in the center of town. And the developer had hired me to market the project. And at the time, he had lined up some lenders to handle the financing, and one of those lenders was McHugh Mortgage, and Pat was the loan representative. That's how we met.
Wow.
But as I mentioned, I had known his dad previously, because my father was in the real estate business as well, and he'd done a lot of commercial investment real estate, and had sold some properties to his dad and another longtime client who were partners on some projects. So I recognized his last name and said, "Are you in a relation?" So we've known each other a long time now.
Oh, wow, that's great. That's great. Let's talk a little bit about construction, new construction. Where are you seeing that?
Interesting, the construction market, new construction market has been relatively strong and recovering. And if you look, for example, at land sales, when you're looking at pricing a property for sale, you look at, one of the things you look at are recent sales of comparable properties. It's been very, very difficult for land, only because, again, going back to the Great Recession, a lot of builders just went to the sidelines. A lot of them really got hurt because they may have purchased the property too high and couldn't sell it. Either they lost it or whatever they did with it. So a lot of them went to the sidelines. So builders started to come out again and recover a little bit. But in terms of pricing the property, we could say, well, there's two numbers on that land. It's what it should be worth and what the comps say it's worth, because there have been so few of them, because there have been so few sales. Right. So, but I've seen some builders started to come back in, and what I'm seeing is fairly strong demand for brand new homes, and a lot of the demand, surprisingly, is some fairly young buyers. I'm thinking, where do these kids come up with $500,000 or $600,000 to buy a home? But there's been pretty good demand. I worked with some builders in different towns. I've got one particular builder who's been developing in Newtown, another one has been developing in Bethel, and we've seen demand. I've even seen some demand from incoming transferees, which is a far less robust segment of the market than it had been previously in Connecticut. There are more people are being transferred away than coming in, but I'm seeing beginning of an influx. But I'm seeing fairly regular demand now for new construction homes, and interestingly enough too, which I think is kind of a good bellwether, builders are regularly looking for land, and I'm seeing more competition for that land. There are more people looking to buy the land, so it's a little bit more of a challenge for the builders to secure the property. So on the supply side, more builders are coming out because they're seeing the demand too. They're seeing the homes sell, but they're still a pretty good value relative to where they were. You can, probably buy a brand new 3,000 square foot house, depending on the town, $500,000, $600,000, and that wasn't the case, say, in 2005 or 2006. That would be $800,000, $900,000 or $1 million.
Right, right. And what are your projections, or what are your thoughts on how the real estate in this area may or may not be affected given the recent tax law changes in the property cap limitation of $10,000?
I have some concerns. By capping the state and local taxes, by structuring it that way, given that we're a relatively high-tax state,
Absolutely.
I think it could ultimately have some downward pressure on prices, because there's only so much a person can pay every month for housing. And if and part of the attraction historically has been the tax incentive associated with home ownership.
Right.
I think it's going to affect properties a little further south from us in Fairfield County, only because those properties are worth more and may have a correspondingly higher tax bill.
Right.
But there are still plenty of properties in and around the greater Danbury area where you'll see taxes that are $10,000, $15,000, $20,000, $25,000 a year. And so as a result, if they can only cap it at 10, they might be less willing to pay as much for that home.
Right.
I think the tax law, while I do see some benefits maybe on the corporate side, which it seems to be filtering down. You're hearing about different companies giving their employees bonuses and things like that, and I hope that trend continues, because more spendable income helps everybody.
Right.
But I do have some concerns about the impact on the tri-state area as that all kind of shakes out, because we're kind of in a high-tax corridor, and it's to be determined, but that portion does concern me.
Right.
No,
Absolutely.
and also there's some concern about the maximum mortgage deductibility at $750.
Absolutely.
Yes, I was just
Yeah.
going to ask you that. Yes.
That's huge.
Yes, and that's for new mortgages going forward,
Correct.
not for existing mortgages.
Right.
Yes. Are you seeing a lot of new construction loans?
On my side, not as much. We tend to handle, if a builder comes to us for construction spending, that's offered through our commercial lending department. So I'm a residential lender. I tend to work with a possible homeowner versus a builder. But just to add on to something that Robert was speaking about, because I have seen this quite a bit, some of the builders, as opposed to building a brand new home, they've been buying houses and renovating them significantly.
Right,
and
right.
I've helped a couple of clients over the last year in particular, where they bought a very, very high-end older home. And so it was a house that was gutted, a brand new high-end kitchen, the higher-end moldings, if you will. Just beautiful, beautiful houses, and it's been a nice alternative to somebody who maybe can't afford a traditional new construction, if you will, but is seeking the benefits of new construction.
Right.
So.
And when you're talking about new construction versus a resale, what's the difference in property taxes? And I'm asking more out of curiosity, just to kind of get an idea.
There isn't necessarily a compelling difference on property tax between new and existing. It really just is really a function of the value.
Right.
A new home typically is going to sell for more, and part of that has to do with the cost, because you're paying for everything in today's dollars, and being on the financial side, you understand what I mean by that, as opposed to anything that's maybe 10 years old has been depreciated. Also, too, the very recent impact, the terrible storms in Puerto Rico and Houston has driven the cost of building materials up quite a bit, 10, 15%, 20% in some cases. So as a result, the builder's costs are now higher, and he's got to pass those costs along. So $1 million house, brand new or existing will be taxed the same way, but each house may offer something different. That $1 million house that's a resale may be somewhat larger, because again, there's a depreciation factor built in, and they haven't had to buy everything and buy the land and build it in today's dollars.
Right. Where I live in New York State, it works a little differently. At least this is my interpretation.
Yeah, the taxes are functioned based on when they sell their
Exactly.
Yeah,
Yeah.
it's not
So
the
if
same
it's
here.
new construction, then I guess they're assessed at the current. The house is assessed, and the current taxes assessed at that point. Where
The
if it's a
current value,
resale,
yeah.
unless they're going through a reassessment, then the taxes essentially are transferred over to the new buyer. Yeah.
Yeah, it's different. In Connecticut, it's really just a function of the value, whereas though, I will say though, in a new construction situation, the assessor oftentimes will use a number that is at or very close to what the sale price was, because that is the clearest establishment of the value, because someone just in an arm's length transaction just paid that for that house, so that establishes the value.
Right,
Yeah.
right. Pat, let's talk a little bit about the mortgage qualification process.
Sure.
For first-time home buyers and maybe lower for people who have some problems with their credit.
Sure. Credit is one of the most important parts of the ability for someone to get a loan. And so when we start speaking with a potential new client, we take them through a pre-qualification process where we ask about their job history. We try to determine what we might call stable income to be, the income that they can depend on, and has been historically available to them for the last couple of years.
W-2 income.
W-2, self-employment, typically, if somebody is a salaried employee, we'll always use their current salary level.
And how do you, I'm sorry.
Oh, sure.
How do you interpret alimony? If you have somebody who comes to you, wants to get a mortgage, maybe has been receiving alimony 12 months, how does that factor into the qualification process?
We will use, as long as they've been receiving alimony for at least 6 months, and regularly. I've had some cases where people say, well, can my ex pay me 6 months at once? And the answer is no. You have to be able to show that you've received it each month for 6 months. Once that's the case, and the alimony and or child support is also usable, with a 6-month history and at least 3 years of continuance going forward, that can be used towards helping somebody qualify for a loan.
Oh, interesting.
So that is an income source if the applicant chooses to use it. Self-employed people, we go through a little bit of a different process. Generally, it tends to be more of a averaging out over a couple-year period, depending on how their income is disclosed.
Right. And it could be more of a hurdle for them.
For self-employed?
Right. As far as documentation request. And again, I'm asking personally.
Sure. Well, not all self-employed people are the same. You've got sole proprietors that are very easy. You have a Schedule C income, and then you've got other situations that can be a little bit more complicated. And to answer your question, yes. Somebody who's self-employed, if they have corporate returns and so forth, a lender's always going to look for the most recent 2 years, and generally a minimum of a 2-year history is required for someone who's self-employed. Typically we don't need to trouble clients for profit and loss statements any longer. That's something that we don't generally need unless unless there's a greater period than a year between the last time a return was filed and we're just trying to verify current income. But even then, in almost all cases, a client can self-generate a profit and loss statement for us. So we can work with that. So after we determine income, we try to get a sense of what kind of assets they have. If they can put down 20%, we'll do a different type of loan than if they need 100% financing, for example. And then we'll also go through, reviewing their credit. And credit's one of the few things that you can't necessarily fix overnight. If we pull a person's credit report and the scores are low, then we'll take the step of trying to figure out maybe why they are where they are and what we could possibly do to change that. And I always tell people, there are people I can help immediately, and there are people that sometimes will take me a year.
To counsel them through the process and try to get their credit score up.
Yeah, absolutely. It's or whatever's holding them back at the moment, and try to draw them a roadmap, stick with them. I've had many cases where a couple years down the road we get somebody to a position where they can buy, and either they fix their credit or they save more down payment or whatever the hurdle was. We identify it and then we move to hopefully fixing it for them.
Right, and you provide a pre-qualification letter. Are real estate agents still asking for that in the process?
There are some listing agents, some homeowners who, even though they should, they won't even consider an offer without one. The primary reason is if they're not willing to take their property off the market, if they have no sense that the person is able to consummate that purchase. And certainly a letter from Fairfield County Bank is going to hold a lot more weight locally than, say, if somebody just goes online and pulls something off the internet or something like that. I mean, it's a long time established institution. Many of the agents in the area will know the bank, and many of them will know Pat. And I know as a listing agent, I receive a letter, I'll look at who's provided the letter, and I may even take it upon myself to contact that loan officer just to confirm what I have, because my client may ask that question. How do I know? Especially if you're in a multiple offer situation.
Right.
But it's just having that. And it's really, there's no legal requirement. It's really more of a function of custom. People are now used to seeing it, so it's kind of like, well, if it's not there, they'll know it's missing. If you'll notice that something's missing. And again, if you're in a multiple offer situation, chances are one of the other offers will have one, and so they'll want to balance that out and make it apples and apples.
Right. The whole process, I sold my house and bought a new house 2 years ago, actually.
Congratulations.
Thank you.
And thank you for your contribution to the real estate economy.
The whole process is so emotional, so I can see where the pre-qual letter makes a big deal.
It is.
Well, you think a seller's potentially missing out on a whole season of being able to sell their home if they take the wrong offer.
Right.
And one of the things that we offer, I tell people all the time, the words pre-qualification and pre-approval are.
I was going to ask you that, yes.
Often used interchangeably, and there's really no legal definition of what's what. I think we all have our own, as loan officers, kind of understanding or feeling of what one is versus what the other is. And one of the things that we do at Fairfield County Bank that I think is excellent is we'll take an application from a borrower even though they haven't identified a home yet, and we'll submit it. We'll put it through the entire process of disclosing the loan, collecting the information, the tax returns, pay stubs, bank statements, and such, and put it into underwriting and issue a commitment letter before the person's even found a home. And it's tremendous for a couple of reasons. One, they in a sense are a cash buyer, assuming that the appraisal is good on the property and the property doesn't have any structural issues that's concerning. But there's also been a change in how loans are disclosed. A couple years ago, we started working through what's called TRID guidelines, and it's just a series of starts and stops in the mortgage process, basically designed that to make sure that somebody's not moving faster than they're understanding the process.
Right, full disclosure.
And it's a good thing, and I think a lot of us, we came to the conclusion that it's some extra work. It's a little bit more managing the process, if you will. But the reality is, it's ultimately, I think, good for the consumer, and I think a lot of people feel that way. And by having the file fully underwritten in advance, they've effectively. They're about 2 weeks ahead in the process when they do find the properties. So it gives them the ability to, not only bid with confidence, but also have a commitment letter instead of just a pre-qualification letter. But they also could possibly close in less than 30 days, which isn't as easily done these days as it used to be.
Right, and it could be very attractive for somebody who has multiple offers.
Absolutely, for somebody who's got multiple offers. So it's what I always tell. It's one of those true win-wins, if you will. It's a win for the potential buyer, and it's certainly a win for the seller.
Right, absolutely. We are going to be wrapping up. Robert, if you would like to give the viewers your contact information or an email address, if they can follow up and have any questions.
Certainly. Again, my name is Robert Morey. I'm a realtor with RE/MAX Right Choice. Best number to reach me is my cell, which is 203-512-1785. By email is robert@robertmorey.com, and you can visit me on the web at www.robertmorey.com.
And Patrick?
Sure. My name is Patrick McRedmond. My direct office number is 203-431-7552. You're welcome to use my cell phone, which is 203-648-7222. Or my email, this is long, but it's my name. It's Pat, P-A-T, .McRedmond, M-C-R-E-D-M-O-N-D, @FairfieldCountyBank.com.
Thank you. Thank you again for joining us, 30 Minutes, and we will see you next time. Thank you.